Hello everyone and welcome back to Investment Research. I'm Simo, an equity research analyst, and I am so glad you're here with me today. In my view, we all dream of financial freedom, and for many of us, that dream often starts with a windfall. Imagine inheriting $1 million. What would you do? For me, the first thought that comes to mind is time. Time to travel, time to build something of my own, or maybe just to breathe a little. And like many of us, my first thought would be, what if I could live off the dividends? It sounds perfect, doesn't it? No boss, no meetings, just money showing up while you sleep. But the options, as you know, can be overwhelming. Some strategies are rock solid but pay very little. Others offer massive returns but come with serious risk. So, in my work, I always want to test them all. In this video, we're going to walk through 7 different dividend strategies, starting with the safest and working our way up to the riskiest. We'll see what kind of income each one generates and, more importantly, what kind of life it actually supports. And in the end, I'll show you an asset that could pay $150,000 in yearly dividends right away. Let's start at the beginning with the most classic conservative choice there is, the dividend-paying blue-chip stocks. I start with the most familiar, least risky name I can think of, Coca-Cola. It's iconic, global, timeless, and when it comes to dividends, few companies are more respected. That's what I want first, a solid foundation, something safe. So, I would consider putting my full $1 million into Coca-Cola stock. With a dividend yield sitting at 2.97%, that gives me $29,700 a year. That's about $2,475 every month just in passive income. On paper, that sounds pretty decent, but let's look closer. At $2,475 a month, I could probably cover rent in a small apartment. I could buy groceries, keep the lights on, maybe cover a basic phone and internet plan, but that's about it. No vacations, no car payments, no money for hobbies, health insurance or savings. This kind of dividend income doesn't buy freedom. It buys just enough to get by with the constant need to stay cautious. The upside, Coca-Cola isn't going anywhere. Its revenue is steady, global demand is strong, and the dividend is among the most reliable on Wall Street. The check shows up every quarter without drama, but I can feel it. That low-level financial tension. There's no slack in the system, no margin for mistakes. One big bill, one health emergency, and things could spiral fast. And that's the irony. I'm technically living off dividends, but barely living. This strategy, in my view, is like using your $1 million to build a small, strong house with no windows. It's solid, but you can't see much of the world. You're protected, but you're not really free. I don't regret the test run though, it gave me a baseline. Now I'm wondering, what happens if I give up a little bit of safety for a little more room to breathe? Let's find out. After seeing what Coca-Cola could do, I don't want to jump straight into riskier waters. Not yet. Instead, I look for a step up in yield, but still within the world of safety. That's when I land on Johnson & Johnson. It's a dividend king. A company that's increased its dividend for over 60 consecutive years. It operates in healthcare, consumer products, and pharmaceuticals. The current dividend yield for J&J is about 3.11%. So what happens when I invest my $1 million into J&J? Now my annual dividend income bumps up to $31,100, about $2,592 per month. That's a slight increase, only about $117 more per month compared to Coca-Cola, but it feels like something. A little more flexibility, a little more room to think. With $2,592 a month, I could afford a slightly nicer apartment, maybe in a better neighborhood. I could pick up a small health insurance plan, maybe save a couple $100 a month instead of watching my balance flatline. But the core reality hasn't changed much. I'm still budgeting every dollar, still living in survival mode with just a better mattress and maybe one takeout meal a week. The dividend is rock solid, and if safety is your number one priority, it's hard to beat. J&J has been through lawsuits, market crashes, industry shakeups, and the dividend just keeps climbing. but now I'm starting to think in bigger terms. I'm not just trying to not work, I'm trying to live, do more, have more time and flexibility. I realize that even ultra-reliable companies can only do so much, especially when the yields are modest. So what if I stop picking individual stocks altogether and let an entire portfolio of reliable companies do the work for me? Time to test out a different approach. I'm getting the hang of this. After trying 2 individual stocks, I start wondering, what if I let a basket of strong dividend companies do the work for me? That's where SCHD comes in, the Schwab US Dividend Equity ETF. It's a dividend-focused ETF made up of companies with strong fundamentals, consistent dividend history, and solid cash flow. Think of it, in my view, like getting a professionally curated playlist of top dividend payers without having to pick each stock yourself. SCHD's current yield is about 3.82%. I would put my entire million into SCHD, and with 3.82%, I'd be earning about $38,200 per year, or roughly $3,183 per month. Now we're getting somewhere. That's enough to cover all the essentials: rent, groceries, utilities, insurance, and still have some wiggle room. I could keep my car maintained, take the occasional weekend trip, maybe even treat myself to a new computer, a nice dinner once in a while, or even start contributing to a retirement account again. No more penny pinching, no more walking on financial eggshells. What's more, the ETF structure gives me built-in diversification. I'm not relying on one company. If one business cuts its dividend, the others help smooth things out. It's a less emotional ride, but it's not total freedom. I would still have to watch expenses, and there's not quite enough to feel totally comfortable if something goes sideways. A medical bill or a home repair could still derail things. And while 3.82% is much better than 2.97%, it still caps my income below the national median salary. So I'm not disappointed. In fact, this is the first strategy that makes me feel almost independent. But the key word is almost. And now that I've seen what a little more yield can do, I wonder what's next. What if I leaned into a specific sector that's known for even higher dividends? I set my sights on energy. Energy companies often throw off serious cash, and many return that cash to investors through generous dividends. The sector is cyclical, yes, but it's also built into everything: transportation, manufacturing, even electricity. I find an ETF called USAI, the PACER American Energy Independence ETF. It invests in US-based energy infrastructure, including pipelines and natural gas companies, businesses that generate predictable contract-based cash flow. In USAI's case, the dividend yield comes in around 4.32%. So I decide to give it a shot. I put in the full $1 million, and just like that, I'm earning about $43,200 per year, or $3,600 every single month. This is a great start, a solid return from a dependable asset. But as we move up the ladder, both in risk and reward, things start to get a lot more interesting. I'm going to show you investments that pay even more, and in the end, I'll show you an asset that could pay $150,000 in yearly dividends right away. Back to USAI and $3,600 in monthly income. That's enough to live alone comfortably in most US cities, cover all bills, keep a decent health insurance plan, and still save or invest a few hundred every month. I could afford weekend trips, upgrade some tech, eat out more often, and support a modest hobby, maybe photography, music, or design. My lifestyle is no longer survival focused, it's flexible. But here's the catch. Energy is unpredictable. Geopolitics, oil prices, regulation, any of these can swing the sector. If earnings drop, so do dividends. And unlike broad ETFs, sector-specific ones don't always offer a cushion if one segment takes a hit. So while USAI gives me the best quality of life so far, it also introduces more uncertainty. Still, for the first time, I feel like I'm actually in control. If I wanted to, I could cut back to part-time or even take a long break from work altogether. Sure, the road might get a little bumpy along the way, but with this kind of income coming in each month, it finally feels possible. But something's still bothering me. If a 4.32% yield from pipelines can give me this much ease, what if I could get this kind of cash flow, but from something even more consistent, like rent? When most people hear the word rent, they immediately think of real estate. And yeah, so do I. But not the kind that comes with clogged toilets, noisy neighbors, or late night repair calls. I'm not looking to be anyone's landlord. I want real estate that pays without the headaches. That's when I discover Realty Income, ticker symbol O, also known as the Monthly Dividend Company. It's a REIT, a real estate investment trust, which basically means it owns things like retail buildings, medical offices, and warehouses, and rents them out to businesses on long-term leases. And because REITs are legally required to pay out 90% of their profits to shareholders, they're known for having some of the highest and most consistent dividend yields around. In Realty Income's case, that yield sits at around 5.68%. I would move my entire million into O. And just like that, I'm earning $56,800 a year. That's nearly $4,733 per month. This is the first time things feel complete. With this income, I can live comfortably in most cities. I can pay for rent, utilities, groceries, insurance, car expenses, and still have room for travel, hobbies, and savings. I'm no longer tiptoeing around every financial decision. I could comfortably stop working altogether or work part-time doing something meaningful. I could even consider starting a project I care about, like a YouTube channel or a small e-commerce shop, purely for passion, not pressure. The best part? Realty Income has monthly payouts. That regular cash flow mimics a paycheck, making it feel more stable and manageable than quarterly dividends. But there are risks. REITs are sensitive to interest rates. If borrowing costs rise, property values can drop, and so can share prices. And while Realty Income is considered one of the safest REITs out there, it's still a sector-specific play, meaning if retail or commercial space hits trouble, income could dip. Still, I see this as a major milestone. This is the first time it feels like dividends could actually support a real lifestyle, not just survival. But after seeing what a 5.68% yield could do, I start wondering, what if I go just a little further up the yield curve? That leads me to a surprising pick, UPS, United Parcel Service. Yeah, the delivery giant with the big brown trucks. Not exactly what most people think of when they hear high dividend stock, but after a recent dividend bump, UPS is offering a yield of around 7.52%. And that catches my attention. It's still a massive, well-established company with global operations and steady demand, but now it's paying more than some of the riskiest names out there. So I run the math. $1 million in UPS would generate $75,200 per year. That's $6,267 a month. Well, that changes everything. Now we're in lifestyle territory. I could rent a bigger place, travel more often, treat myself without guilt, and even fund a creative side project like writing a book or building an app I've always talked about. I could help out family, support a charity, or just enjoy life without budgeting every penny. For the first time, the income isn't just covering life, it's creating space for joy, for freedom, for new possibilities, but this isn't a free ride. The shipping industry is cyclical. Economic slowdowns hurt volume, labor negotiations, fuel costs, and automation pressure margins. Not to mention, a high dividend means a high payout ratio, which makes it vulnerable to cuts if cash flow dips. I realize this isn't like Coca-Cola or Johnson & Johnson. This is a company that could surprise you in either direction. Still, the appeal is strong. With $75,000 a year, I could live well, build something, or do nothing at all, and do it without watching every penny. And now I'm asking the question anyone else would ask at this point. What if I took this even further? Not 7%, not 8%. What if I went all in on something yielding 15%? It's bold, it's risky, but maybe it's the final step toward full-on freedom. I've seen what 7.5% can do, but what happens when you double that? That's when I come across AGNC Investment Corp, a mortgage REIT that offers a dividend yield of around 15%. At first glance, it almost feels too good to be true, and in some ways it is. A GNC makes its money by investing in mortgage-backed securities. And while those can be stable in calm markets, they're also incredibly sensitive to things like interest rates, borrowing costs, and housing trends. When things go well, it's great, but when the tide turns, those big payouts, they can vanish fast. Still, I'm curious, what would it look like if I leaned in completely? With $1 million invested in AGNC, I'd be bringing in a massive $150,000 a year or $12,500 every single month, and now with that income, the possibilities are endless. I could live anywhere in the world, take multiple international trips, support my family, and invest in anything I care about. I could take 5 years off if I wanted. I could live stress-free if the income lasts. And that is a big if. Mortgage rates like AGNC are notoriously unstable. Their dividends fluctuate, their share prices can drop sharply in a bad year. And while 15% sounds like magic, it's also the yield of desperation, a payout that may not be sustainable in the long term. I know this. I read the warnings, I see the risks, and yet the possibility lingers. This is the only strategy that would give me everything I want right now, complete freedom, but with a ticking clock. So the real question here isn't, can I live off this? It's, how long can I count on it? For me, that uncertainty outweighs the temptation, and it leads to a deeper realization. Freedom doesn't come from chasing the biggest number. It comes from finding a number that you can truly rely on and live with. Now, as an equity research analyst, I've had my share of experiences in the early stages of my career, working with some respected firms. I've seen firsthand how tempting it can be to chase those high yields, to take on leverage, to borrow money to amplify returns. I remember moments when the allure of quick wealth was almost intoxicating. I'd be crunching numbers, seeing the projections, and thinking, if I just add a little more risk here, I could drastically accelerate my goals. But I also learned the hard way about the crucial difference between paper returns and sustainable income. Early on, I even considered taking out a margin loan to double down on a high-yield opportunity. The math looked fantastic on a spreadsheet, showing me double the potential income. But the financial modeling also laid bare the severe downside risk. A modest market downturn and that dream of accelerated freedom could turn into a nightmare of margin calls and debt. The very independence I sought would be jeopardized. This kind of analysis, as you know, is what we do. We look beyond the headline yield to the underlying fundamentals. We scrutinize the payout ratio. Is the company earning enough to actually cover those dividends, or are they borrowing to pay shareholders, which is a red flag indicating an unsustainable distribution. We analyze the debt-to-equity ratio, examining the company's leverage and its ability to weather economic storms. We assess the stability of their free cash flow because ultimately, dividends are paid from cash, not just reported earnings. The lesson I took from my early career, one that I share with you today, is that true financial security isn't about the highest percentage. It's about reliability. It's about knowing that come rain or shine, that income stream will persist. That peace of mind as an analyst is something you cannot quantify on a balance sheet, but it's invaluable. Now, I created this channel so I can discuss my financial analysis and share my financial insights with you all. I believe in transparency, and it's important for me to say that, like everyone, I may make mistakes in my analysis. I am, after all, a human being. My goal is to continually learn and grow alongside you, and later on I will be appearing on camera for more live analysis of stocks and for comprehensive discussions on various financial topics. This journey is about shared knowledge and evolving insights.